Stop chasing speculative tech stocks and hoping for a market miracle to fund your dream lifestyle. It is a losing game. The brutal truth that Wall Street rarely mentions is that most everyday investors fail miserably. Their downfall stems from a total lack of a structural framework for their payouts, regardless of which stocks they actually pick. They cross their fingers, buy the hype, and pray the market goes up right when their bills come due. But hope is not a financial strategy. Years ago, while analyzing financial frameworks deep within the banking system, I saw firsthand how traditional portfolios crumble under real-world pressure. I watched smart people lose their life savings because they were forced to liquidate their assets at the absolute worst times, just to cover their monthly expenses. That is when I realized the system works against normal people who simply want safety and freedom. Today, I am going to expose the exact blueprint the wealthy use to bypass these traps. It is called the three-bucket dividend system. In this breakdown, I will show you precisely how to organize, partition, and automate your portfolio so you can replace your primary salary with predictable, passive cash flow. Let's be completely honest with each other. The old-school financial advice your parents relied on is dead. Specifically, the classic 4% rule. For decades, financial planners shoved everyone into the exact same drill. Build a massive nest egg of growth stocks, sell off 4% of it every single year, and assume you will never run out of money. Look around you. With massive inflation volatility and wild market swings, that rule is broken. If the market drops by 20% tomorrow and you are forced to sell shares just to pay rent or buy groceries, you are liquidating at a massive deficit. This chart illustrates sequence of returns risk. Forced withdrawals during a downturn permanently destroy your portfolio's compounding power. The psychological exhaustion is severe. Imagine your net worth plummeting, yet you still must liquidate bleeding shares to pay basic utilities. It is a slow-motion train wreck. We need a system that ensures you never have to sell a single share of stock at a loss just to survive. We must transition your capital away from pure growth stocks and into defensive assets. Let's break down the 3 structural changes you need to make right now. Let's dive straight into the mechanics. Bucket number 1 is your cash buffer. Think of this as the heavy-duty shock absorber on an off-road vehicle. It keeps your life running smoothly when the market hits a pothole. The constraints for bucket 1 are strict. It does not hold stocks, it does not hold crypto, and it absolutely does not hold speculative assets. Instead, it holds exactly 12 to 24 months worth of your bare minimum living expenses entirely in ultra-safe, highly liquid cash equivalents, like short-term treasury bills. Consider this municipal water tower blueprint. It doesn't create water, it stores a massive, elevated reserve. If city pumps temporarily break down, citizens don't notice. Gravity simply pulls clean water straight from the tower into their homes. Your cash buffer is that water tower. If the stock market goes through a brutal recession and your dividend payouts temporarily dip, you do not panic. You have 2 full years of cash sitting safely in bucket 1, completely insulated from the market. You draw your monthly salary directly from this fully insulated bucket. This removes the psychological panic of investing because you know your bills are paid for the next 24 months, no matter what happens on Wall Street. Once your cash buffer is locked and loaded, we move to the engine room. Bucket number 2 is your income engine, where true passive cash flow is generated. The core objective here is simple. Generate consistent, high-yield monthly and quarterly payouts that actively refill bucket 1. Instead of betting on volatile companies, we target reliable income-producing assets. We want dividend aristocrats, companies that have increased payouts every year for 25 years, along with high-yield ETFs and real estate investment trusts. This schematic shows why this strategy beats a pure growth portfolio. Think of bucket 2 as a mature orchard. In a growth portfolio, if you want to eat, you have to chop down the tree for wood. With our income engine, we leave the trees intact and simply harvest the fruit. Every dollar of dividend income automatically flows backward to fill bucket 1, or flows forward to buy more shares. Automating this directional cash flow creates a self-sustaining ecosystem. It actively expands your wealth every single day without you actively managing it. Finally, we have bucket number 3, the Growth Accelerator. Now, you might logically ask, if we rely so heavily on dividends, why do we need a growth bucket at all? The answer is simple. We need to aggressively beat long-term inflation to prevent the erosion of your purchasing power over the next few decades. Bucket 3 is populated by highly profitable tech and healthcare companies. They might have a low dividend yield right now, around 1 or 2%, but they are aggressively growing their earnings and doubling their payouts every few years. Look at this time-lapse grid of young saplings. Over time, they scale into heavy-yielding trees. You systematically harvest those capital gains, pouring them down into bucket 2 for immediate income, which keeps bucket 1 completely overflowing in a perfect closed loop. It is a perfect automated cycle. You secure your future purchasing power while simultaneously funding your immediate real-world survival. To act smart and execute the system immediately, you must abandon the complexity of traditional investing and the broken 4% rule. Partition your capital into 3 distinct liquidity buckets. Bucket 1 is your cash buffer, insulating 12 to 24 months of pure cash to eliminate market panic. Bucket 2 is your income engine, packed with high-yield dividend assets that act as your fruit orchard, consistently producing the cash flow that funds your lifestyle. Bucket 3 is your growth accelerator, deploying aggressive dividend growth assets to shield your wealth from inflation over time. By executing this tiered structure, you completely and permanently decouple your monthly survival from the volatility of the stock market. You stop worrying about what the market does today, because your life is funded by predictable cash flow. That is how you break the 9-to-5 grind and construct an ironclad wall of passive wealth. Thank you so much for watching, and don't forget to subscribe if you haven't already.